Hi, everybody. Welcome to our final session of the personal finance from mystery to mastery session. We've covered a lot of material, and the honest truth is, if you guys master the material in these 10 classes, you're going to be doing a lot better than almost anyone in personal finance because most, even financial professionals, have not mastered this kind of stuff. So, for example, I worked with someone who was the CBO of a business unit in a finance company that I worked for, and he did not have a term life policy for his family, even though he was the sole breadwinner. So stories like this just show you how we don't give enough attention to our personal finances, and by taking the time to learn all this, you guys are doing exactly the right thing to position yourselves well to have a smooth and steady financial life. Before we get started in the final class, wanted to give you one quick administrative update. We're going to take a little bit of a hiatus from the video series for next week. We'll resume 2 weeks later because I want to put some attention to developing a few tools for the members that we're pretty excited about. We'll resume with the top 150 stocks series in 2 weeks. And with that, let's get started with today's class. Last session, we covered the role of the final pillar of your financial health. So, protection. Why do we need protection around our finances? We understood that there are ways to protect beyond just insurance. You can use your savings, you can use borrowing also to act as forms of protection. And we learned that insurance is generally the option you use when you cannot use those other two tools to protect your assets. And we figured out how to go about finding the right amount of insurance for yourself. So we looked at a case study of someone trying to find the right amount of life insurance for his family. And we concluded with a little bit of an overview on some insurance jargon. So there's a lot of jargon in the insurance world, and we covered some of that in the last session. So again, if you've missed any of our sessions in the series, they're all available on the YouTube channel. You can watch them at your leisure. So what are we going to cover today? So we're going to conclude with insurance by first explaining why we don't recommend insurance as an investment. Second, we're going to give you our final recommendations on how to use insurance well. And then we're going to conclude with a holistic view of all that we discussed in this series and what the key takeaways should be from all of our explorations. Like, what are the key themes that are common throughout all of the pillars? So that's the agenda for today. And then I'm going to conclude it with some thoughts on our next beginner series. And I'd love to hear what you guys would like us to do next for the beginner topic. Please share your feedback on all of that. Okay, so let's start with why insurance as an investment is a product. The most common application of life insurance in India is actually not as a protection product. If you look at the data on what kind of policies are sold in India, the vast majority are either ULIPs or a commingled plan of protection and savings combined. And it sounds very good because it seems like you're getting one product to do the job of two products. So I can take care of my protection and I can take care of my savings, and I just need to deal with one company, pay one premium, and everything's taken care of. It sounds great. It sounds like it simplifies your life. Now, that would be great. And, if life were that simple, it would be wonderful. Then we could have a successful protection product and savings product. But what ends up happening is that because these two products are combined into a single product, the customer has very little transparency around the pricing. So I'm paying one premium. How much of my premium is going towards building savings in the investment product? How much of my premium is going towards covering the insurance and protection portion of this? It's not very easy for the customer to understand that. And the insurers know that. They know that these products are less transparent, and so typically these do not end up being good deals for the customer because insurers can uh, extract additional profit margins because of this lack of transparency. It's very hard for you to shop around these products because they're all customized and slightly different from other products. So what ends up happening is you don't get a good deal on the insurance and you don't get a good deal on the investments because it's all commingled. You can't even tell. So our first recommendation before we even get to avoiding upsells is use protection products for protection. Don't commingle your savings with protection. Use a mutual fund or stocks or small cases to handle your investing side, and use insurance to protect your assets. That way you'll be very clear how well your investments are performing. You'll be very clear how much you're paying for insurance. And so you can analyze if you get a better deal, then you can switch. If it's all commingled, you're never going to know if you should switch or not. So, okay, what are some other recommendations that we have for using insurance right? The first is avoid upsells. When you're shopping for insurance, you're in a vulnerable position because you're thinking about the risks that could occur to your family. And this tends to be very emotional, and insurers also know that, and insurance distributors know that. And so they try to upsell you. So quotes like this can happen. So, sir, you have a term life cover now, but what about critical illness? So this covers you for 7 critical illnesses, but what about 2 more for additional premium of X? Now it's very tempting to fall into the trap of saying, yeah, what's wrong with paying a little bit more for extra protection? But generally, this leads to overinsurance. The best way to avoid these upsells is to realize that you're in an emotionally vulnerable situation when you're being sold insurance. Before you get to that conversation, do your own thinking around what exactly are the risks that I need to protect myself against. Do I really need to protect myself on 9 critical illnesses in addition to a term life cover? You really need to assess what is required of you. And if you decide, yes, I need this, then go ahead and get the upsell as well. But don't leave it for the actual discussion because the insurers will try to push you, and you're going to be on shaky ground because you'll be thinking about these risks, etc. Insurers may also try to upsell you on bonuses or reward money that they pay you if you don't get sick. So these sound great, right? So insurer will say, if you pay us a little bit more premium, then if you don't pass away over the term of the policy, you'll get a big bonus back. Now, typically these products are not good deals because the extra amount that you're paying the insurer for the premium, it's almost like a savings that you're putting into the insurance. And you typically don't get a good rate of return on the bonus money. So we recommend just stick to plain vanilla term life insurance. It's not a good idea to commingle savings and protection products together. Okay, the second recommendation, how do you pick an insurer? So one recommendation that we have is stick with large insurance companies that are brand name companies. So whether it's the HDFC Lifes of the world, the ICICI Prudentials of the world, the Tata AIGs of the world, these are large companies. And insurance is a business that has something called economies of scale. If you're not familiar with that term, it basically means the bigger you are, the better you're able to serve your customers. And the reason for this is when insurers have lots and lots of customers, because of the law of large numbers, they have less risk in the portfolio and less volatility. And insurers are therefore able to, when they're larger, offer lower premiums because their risk levels are lower. Large insurers also have more data, they have more history, they can look at the data to price risk better, and that also allows them to offer generally lower premiums. And most importantly, when you're buying insurance, you're paying money up front. Every year you're paying some premium, or maybe even you're paying your whole premium up front in certain policies, and you're banking on the insurer honoring his contract when you need it, right? So if I pay money in a form of a premium and my insurance company goes bankrupt and cannot honor that contract, then what's the whole point of all the premiums I paid, right? So we want to look for insurers that also have a low risk of default. If you stick to the name brand insurers, you're pretty much assured that they will, because they're very tightly regulated by the IRDA, which is the organization that reviews insurance companies. And they're also large companies with big balance sheets. Okay, so that's tip number one when picking an insurer: pick a large company. Two, look at more than just the premium. It's very easy to say, okay, this company's premium is half the cost, I'm going to go with this company. But you're not just concerned about cost, you also have to look at the service levels of the insurer. So one is, what are they covering, right? The premium may be lower, but this insurance company may be excluding more things from what is covered and what is not. So look at the fine print, make sure you understand the differences between policies. And the last piece is, look at the settlement ratio. The settlement ratio basically tells you, of 100 claims that were made by the customer, how many did the insurer ultimately agree to settle? So companies with high settlement ratios, you can get confidence that when you have a claim, chances are it'll be approved. Some insurance companies will find X, Y, or Z reason to reject a claim. And those companies will have lower settlement ratios, and that's a red flag. You don't want to go for companies that have low settlement ratios, because you can't bank on them honoring the insurance contract. They may find some little thing that you did which will void the policy, etc. So always make sure that you look at the settlement ratio as well. Okay, recommendation three is perhaps the most important recommendation in the protection series. Store your policy details carefully. As soon as you enter into the policy, read the agreement, figure out all the key nuances about your policy, and put them away in a file. So some of these numbers that are important: how much is the insurance cover or sum assured of the policy? How much is the amount of risk that the insurer is going to cover? What is the term of the policy? When does it expire? You want to know when when the policy lapses. What are the coverage areas and exclusions? Where does the policy not cover you? And what constitutes a breach of the policy? One of the biggest mistakes that we see with our members sometimes is that they have an insurance policy and they assume therefore that they're covered, but they have not read the fine print. And for example, there's a case of a member that uh, had an illness, went to the hospital, a serious illness, went to the hospital, had a top up health coverage, and unfortunately picked the wrong room type. And because of that, the insurer refused to reimburse him for his procedures. He didn't know the details of his policy. When he had this emergency procedure, he didn't have time to check his policy details, and he made that mistake. And therefore, the reimbursement levels were way lower than they should be. So don't leave it till the time when you really need to know the details Actually do them when you don't need them. Put them away in a handy place where you can access it when something unexpected happens. That way you'll know exactly what to do if an emergency hits you, and you'll know how to make sure your insurance kicks in and what not to do to prevent it from kicking in. Maybe it could be you need to opt for this type of room, not that type of room. You need to go to this hospital, not that hospital. You need to know all these details. So keep them away in a file. Okay, so let's put it all together, all the topics that we discussed about on insurance. One, the key that where it all starts in protection is figuring out what risks you need to protect against. So this involves asking questions about your family, your personal situation, and figuring out, where do I need to find ways to cover risk. Then determine which of these risks you can cover without insurance. Remember, we talked about savings. If you have a high level of savings, your savings can act as your cover for risk. So, for example, if I have a big safety net of money, a lot of savings, and I'm driving a pretty, sort of affordable, economical car, maybe I won't opt for comprehensive auto coverage because my savings are enough to insure me against any damage to that car. But if I'm driving a Ferrari, maybe my savings aren't good enough. So understanding when you need insurance and when you don't is important. So for the portion where you need insurance, then determine how much insurance you need. You can look at the example we did in the last video, but basically what you do is you figure out, if this risk happens, how much how much proceeds do I need? And that will determine how large the policy should be for you. And then find the best deals by comparing different insurers' offers very, very carefully, understanding the fine print and using the template that we discussed just a few slides ago. And store your policy details very, very carefully so that you have them on hand when you need them. Okay, so that covers protection. So now we've completed a lot of material. We've completed the entire 4 pillars that, if you master, will set your personal finances up for stability. So savings were our raw materials, right? They fueled the rest of the pillars. Investment, that was how we turned our savings into more than just savings. They tried to grow our savings. Borrowing, borrowing was a powerful tool that we could use to invest in ourselves when we didn't have the savings to do it. Maybe I needed to go to an MBA program, didn't have the savings to do it. I could borrow to go to that MBA program to further increase my wealth. So borrowing is a very powerful tool when used right. And then we had the final pillar of protection, which helped shield us from the unexpected events that occur in life. And that's a vital step of ensuring stability in your personal finance health. So the astute listener will probably notice in most of our sessions, saving seems to be the cornerstone of personal finance health. It is the most important ingredient in terms of building your financial health, because strong savings allow you to invest better. Why? Because if you have lots of savings, then you can take more risk in your portfolio and you can earn higher returns. As an example, let's take the example of someone who didn't have a lot of savings, and we had the market crash that we had in March. They would be very tentative about putting money in the market. Maybe they would have taken money out of the market because they don't have a big savings net and they need the money to be safe and secure. But if someone had lots and lots of savings, they probably would not have taken the money out of the market, and as a result would do better over the long run, because they have the comfort of knowing, okay, if the market's down, it'll again go back up one day, right? So having savings allows you to invest better. Strong savings also makes you less dependent on borrowing. If something unexpected happens in your life, you lose a job, or run into unexpected medical costs, if you have a lot of savings, you can fund those expenses through your savings, and you won't need to borrow money and pay an interest rate. Strong savings also can serve as a self-insurance mechanism, as we discussed. So having strong savings plays a role in every single pillar of financial health. And the really nice thing is, it's the thing in our financial health that is most in our control. We can't control if our stocks that we've invested in go up or down, but we can control whether we save more or less, because we control how much we spend. So savings is the most important ingredient to your financial health, and luckily it's also the ingredient where you have maximal control. So really focus on trying to up your savings rate, and you'll do really, really well in the long run in terms of building wealth. Okay, so we've covered a lot of material. Are there any common themes that sort of jump out to us from how to use all these pillars well? And in my mind, there are three common themes that come out in terms of making sure you operate your personal finances well. One is ask questions. Whether it is in your savings, whether it is in your investing, whether it is in your protection, finance rewards people that ask a lot of questions. Do I really need such a fancy car? What are the risks of this investment? Will I be able to repay the loan if I don't get the top job out of the university? How do I protect my family finances from medical costs? By asking these questions and searching for answers, you are proactively going to make better financial decisions. So keep asking yourself questions. Every time you do something consequential for your finances, before doing it, always ask yourself questions. Let's say you're in the market for a new flat. Do I need to buy this or should I rent this? Okay, how much should I spend on my rent, right? Do I really need to live in such a nice place? What if I lived in a slightly less nice place? Would I still be happy? Would it work for my family? Asking questions like this will help you create wealth. Second big theme: review periodically and stay organized. So another key theme that came across was tracking your financial health is very important. Whether it's tracking your expenses through budgeting, which we covered in the first and second sessions, whether it's monitoring your investments, which we covered in the third and fourth sessions, whether it's making your loan payments on time, or whether it's recording your insurance details carefully so you have them when you need them. Stay organized and review this stuff constantly. Because I'll give you an example. I didn't follow my own advice recently. So I have a property in the US, which I'm renting out, and my homeowner's insurance policy lapsed. And I didn't realize that because I wasn't reviewing that as much as I should. And as a result, I had a little bit of a leak that I needed to fix. I thought my homeowner's insurance would cover that. Guess what? My homeowner's insurance had lapsed. So you want to prevent mistakes like this, right? So staying on top of your details is going to help you do that. Last key theme: compare. Always compare against another thing where you can see, are you doing well or not? So what do you do for your expenses? How are my expenses this year versus last year? Am I spending more, less? Am I being more wasteful? Am I being more frugal? That's a great exercise to do. How does this investment option look versus that investment option? What about this loan versus that loan, this policy versus that policy? The more you compare, the better decisions you make. If you do these activities, it'll keep you in good shape and it'll be very hard for you to make drastic mistakes. But even if it's hard for you to make drastic mistakes, don't expect perfection. Life is imperfect and the future almost never goes exactly according to plan. And the more that we expect the unexpected, the less surprised we'll be. So whether it's, and I've experienced this a lot because I've worked in the investing side. You'll do a lot of work on an investment and you'll feel like, okay, 100% this is going to work out. You can never feel like anything's 100% in finance. Let me tell you that from all the experience I've had. It's very, very hard to anticipate everything in life. So when you are planning your personal finances, always stay humble and always expect some mistakes will happen. And if you organize your personal finances to handle those mistakes, then they won't be a big deal when and if they happen. Okay, so with that, I'm going to conclude and open for Q&A. But before that, I just wanted to throw out a few topics that I had been thinking about for the next beginner series. So if there are any others that you recommend that we think about, just email us at advisory@bharosaclub.com with your ideas and we'll consider them as well. So the couple that I thought about is, one, how to use Microsoft Excel to get on track with your finances. So this series would basically walk someone through what a powerful tool Excel can be and some of the formulas and some of the spreadsheet techniques that you can use to really stay on top of your finances. So that's one that I thought about. And the second one was a series on retirement. So we talked a lot about how personal finance is a means to retirement, but what does retirement actually mean? How does our life change in retirement? What do we need to analyze once we are retired? That also, I think, could be a topic that could be pretty beneficial for our listeners. But let us know if there are any others that you think we should think about doing next. So with that, congratulations for making it to the end of personal finance, from mystery to mastery. If you go through all of this, you really will become a master.
Okay, so Sahil, there's one question.
Sure.
If a brand like Aegeon focuses daily on term life insurance, sold direct, and sells most of its policies to reinsurers, would you recommend using it?
Um, so selling policies to reinsurers is actually a net positive to a customer, because generally when uh, insurer does that, reinsurers have tons and tons of capital. So for example, Berkshire Hathaway is a reinsurer and has tons of capital, so the risk of default goes down. The one thing you want to sort of keep an eye on with companies like this, the settlement ratios may be an area of concern, so I would monitor those. But if the settlement ratios were decent, the practice of reinsuring itself would not concern me that much. It would actually uh, may make me feel more confident in the ability of the insurer to service my claim.
Okay, well, it looks like there are no more questions, so we could end today's session. Okay. There's one question saying, asking on senior citizens.
Yeah.
Senior citizens may not get a good term insurance.
Yes. So that is a very good point. Term life insurance is generally very useful for people that are on the younger side. And the reason for that is obviously the insurer, when they do their calculations about risk, the older and older you get, the more likely it is that you will pass away within the term of the policy. So it becomes very expensive for seniors to buy term life insurance because the likelihood of mortality rises significantly. But the good news is that seniors also have less of a need for term life insurance, because the goal of term life insurance is really to replace salary that gets lost when someone passes away. Most seniors are retired and are not earning income and managing their expenses such that they will not need salary income. So there isn't also much of a need for term life insurance.
So, there's a question on, is there a correct instrument for senior citizen, which kind of covers this space of insurance?
Yeah, yeah. So I think for seniors, the most important things to look at in terms of insurance products are health products. Life is probably not so important to insure at that point. Even things like auto, you can opt for less comprehensive policies and just simple basic plain vanilla policies and save on premium there, because at that point you're probably got enough savings to handle anything that happens to your automobile. What you really want to be focused on is understanding if, let's say, you get expensive medical costs, do you have the resources to handle that? And so looking at medical insurance options is probably the most important for seniors.
So, they also want a little bit of information on health insurance.
Sure. So we can do a detailed session on health insurance. It's a very complicated topic because obviously there are all kinds of policies, etc. There's top-up policies, standard policies. We can explore that in detail at a later topic, but we'll add it to the queue of things that we do.
Yeah, I think so. I think we should do a separate session. So maybe we could add that to the retirement series.
Yeah, that's a logical place to have it. From a senior perspective, what is the right strategy to use for health insurance?
Yeah, yeah. Okay. Any comments? There's one more question. Any comments on Policy Bazaar?
I think Policy Bazaar is a great tool. I think it lets you sort of compare policies very well, and the customer service is also very good. I think it's a tool that you can use to shop around pretty well. The other thing that I would recommend for people that are in the market for policies, do a little bit of homework and then buy direct from the insurer, because generally you're able to get better deals when you go direct. The worst thing you can do is go through an insurance distributor because they're taking a cut of the premium. So they're getting a commission. So many times, so for example, HDFC Life, if you buy a policy direct from HDFC Life, you'll get a 5% lower premium. So um, so I'm not sure how the Policy Bazaar premiums compare to going direct. My guess is they're pretty close, but I'm not sure. So you can use Policy Bazaar to do your homework on the policies, get a quote from them, and then compare it to going direct to the insurer to see if the deal is the same. That's kind of the strategy I'd use. But Policy Bazaar is a very good tool for seeing the options and getting a sense of where the market is on insurance.
Okay. Well, that's it for the questions for today. So I think we can wrap up.
Okay, great. Thank you everybody for joining us for this personal finance from mystery to mastery session. It's a real joy for us to cover these topics, because though they seem simple, there's a lot of misuse of these products, etc. So, and like I said, even in my own financial health, I've talked through numerous examples here where I've made mistakes. And so even knowing this information, you make mistakes. So that's the beauty of this content. The more time you spend with it, the more time you try to implement it, you get closer and closer to making no mistakes, but even then you will make mistakes. So do the best you can, guys, and hopefully it was useful. And then we'll move on to future beginners classes. Let us know your thoughts, and bye for now.
Okay.